We're heading straight into Christmas week in the stock market, and this is usually the moment everyone starts talking about the Santa rally. But here is the thing most people are missing. If you read blindly chasing a holiday bounce without understanding what's actually happening under the surface, setting yourself up for a rough start to 2026. Bitcoin is hanging on by a thread. AI and quantum stocks are deep in bear. Markets volatility has completely collapsed, and yet, at the same time, some of the biggest mega-cap stocks we've ever seen are trading at valuations that almost don't make sense going into next year. That combination alone should tell you one thing. This is not a normal market, and the opportunities and risks going into 2026 are going to be very different from what most investors are used to. Here's what really matters right now. We're in Christmas week, which historically is a low-volume environment where moves can get exaggerated. The VIX is absolutely crushed because CPI is out. The Fed is done talking for the year, and there's barely any economic data left on the calendar. When volatility gets this low, it doesn't mean risk disappears. It means it's being priced incorrectly. And that's exactly when smart traders and investors start preparing, not chasing. Now, in terms of data this week, there really isn't much left. We get preliminary GDP on Tuesday, December 23rd. December 24th is a half day. December 25th, the market is closed. December 26th, the market is technically open, but let's be honest, it's going to be a ghost town. Low volume, thin liquidity, and that's when you can get sharp moves in individual stocks, while the indexes barely go anywhere. And that is why I don't really care about the Santa rally when it comes to the S&P 500 or the Nasdaq. Yes, the S&P could make a new all-time high. Historically, if we do get a Santa rally, it's about 1 to 1.5%. And right now, we're already about 1% away from all-time highs. I'm not interested in tying up capital just to squeeze out a 1% move in an index. What I care about is what can move disproportionately, the stocks that have been beaten down, mispriced, or ignored, but still have real catalysts going into 2026. That's where things start to get interesting. If you look at AI, quantum, and other high beta names, a lot of these stocks are already in bear markets. Not corrections, full-blown drawdowns. And when that happens while volatility is low and liquidity is thin, it creates very specific types of setups that can be extremely attractive if you manage risk correctly. Take D-Wave, ticker QBTS, for example. This stock has been absolutely crushed. From its highs, it is down roughly 60% at the worst point, and still about 42% off the top. But here's what matters. The long-term downtrend that started back in October has now been broken. When you measure the most recent leg lower, price stopped almost perfectly at the golden pocket and bounced. That level also happens to line up with the previous all-time high, which makes it a major area of confluence. On top of that, price retraced into a fair value gap after breaking the trend line, which is exactly the type of structure I look for in swing setups. And here's what really caught my attention. Last year, starting around December 20th, QBTS ran nearly 90% before the January slowdown kicked in. I'm not saying that's going to happen again, but what I am saying is this setup is low risk and asymmetric if it confirms. If it breaks out, you have room to the upside. If it fails, your risk is clearly defined. That is the type of trade I want when we're heading into a new year with uncertainty. And just to be clear, this isn't about predicting a Santa rally. Even if the indexes barely move, names like this can still make outsized moves because they're coming from deeply oversold conditions. That's where traders make money, not by guessing direction, but by finding favorable risk-to-reward setups. Another name I'm watching closely is CoreWeave. The volume that came in recently was one of the largest buying days in the company's history, second only to the volume that marked the bottom back in September. That matters. Big volume doesn't guarantee a reversal, but it tells you institutions are paying attention. Structurally, CoreWeave is still stuck in a broader down channel, so I'm not chasing it. What I want to see is a break above the last lower high, followed by a retest. If that happens, a move back toward the upper trend line becomes very realistic. We saw the exact same pattern play out in August and September before the stock ripped higher. Now, not everything I'm looking at is a high beta AI name. One of the cleanest quality setups right now is Google. Google has been stair-stepping higher, respecting the 21 and 9 EMA, and just filled a key gap from late November. From here, a move back to all-time highs offers a very clean 2-to-1 risk-reward setup. That's the kind of trade that doesn't require heroics, just patience and discipline. And this brings me to something really important, because a lot of people confuse trading with investing. Trades are about structure, risk, and timing. Investments are about valuation, durability, and long-term growth. Going into 2026, you need to understand both, and more importantly, you need to know which one you're doing. Let me show you a simple trick to quickly identify potentially undervalued mega-cap and large-cap stocks. This isn't magic, and it's not some secret indicator, but it helps narrow the field. Using a stock screener, you filter for companies with market caps above $200 billion. Stick to major indexes, and then sort by forward pay. Forward pay is the current price divided by expected earnings for the next year. In this case, 2026. This immediately shows you where expectations are low relative to price. Micron is a perfect example. After crushing earnings, Micron's forward P is hovering around 9. For a mega-cap tech-related company, that's incredibly low. Now, does that mean it's going to double next month? No. Value stocks don't move like that. But it does mean expectations are compressed, which gives you margin of safety. This is also where people get confused about pay versus forward pay. Pay looks backward. Forward P looks forward. And what really matters is the relationship between the two. When a company's forward pay is significantly lower than its current pay, it means earnings are expected to grow. That is why companies like Broadcom and Palantir can trade at high valuations, because their earnings growth is projected to catch up. On the flip side, if a company's forward P is higher than its current pay, like United Healthcare, it suggests slower growth ahead. That doesn't make it a bad investment. It just changes your expectations. You're buying stability and cash flow, not explosive upside. And this is why valuation alone isn't enough. You also have to consider competitive advantage, debt, and free cash flow. Salesforce might look attractive on the surface, but competition from Microsoft and Palantir matters. Oracle might look cheap on earnings, but its heavy debt load shows up clearly when you look at free cash flow, which is currently negative. So going into 2026, my game plan is pretty straightforward. For long-term investments, stocks like Meta, Netflix, Amazon, and even non-tech names like Costco start to make sense as dollar-cost averaging candidates. But personally, I'm willing to wait into Q1 to see if we get the typical slowdown that happens almost every year. If high beta names pull back further, that's when I want to step in more aggressively. Now, zooming out to the bigger picture, 2026 is shaping up to be a very different year. Composite models that factor in midterm election cycles, fourth-year bull markets, and years ending in 6 suggest modest gains, not blowout returns. I don't think 2026 will be easy. I expect long stretches of chop, sharp pullbacks, and plenty of fakeouts. But I do think we can still grind higher by the end of the year. Beyond that, things get murkier. The yield curve has fully uninverted across multiple measures, and historically, that has always preceded a recession. The labor market is weakening, job growth has stalled, unemployment is rising, and the AI hype that once sent stocks flying overnight is no longer enough on its own. That doesn't mean the market is doomed. It means we need to be more selective. And here's the key takeaway. This market is not wildly overvalued at the top. When you compare today's forward PEs of Nvidia, Apple, Microsoft, Google, Amazon, and Meta to the late 1990s, it's not even close. Back then, valuations were insane. Today, most of these companies are below 38 times forward earnings. That tells me this cycle still has room to run, just not in a straight line. You can be bullish short-term and cautious long-term at the same time. You can trade aggressively while investing defensively. Most people struggle with that distinction, and that's why they get confused by headlines and thumbnails. My goal is to give you the full picture, not hype, not fear, but context. If you want to see how I trade these setups live, there is a link in the description where you can trade with me every morning at the open. If this video helped you see the market more clearly heading into 2026, hit the like button, subscribe to the channel, and turn on notifications so you don't miss what's coming next. Stay safe out there, enjoy the holidays, and I'll see you in the next one.